Hey, what's up everyone? My name is Rohit and today we are going to be talking about the top 3 stocks to buy in 2025. Now before we get into this video, I have to read a super quick financial disclaimer. Okay. Disclaimer. This video is for informational purposes only and does not constitute official financial advice. Please consult with a licensed financial advisor before making any investment decisions. Always do your own research and make informed choices based on your own personal financial situation. Okay, cool. Now that's out of the way, let's get into it. In this video, I'm going to break down each stock one by one and give you some in-depth financial analysis. And if you watch till the very end, the last stock I'm going to reveal is... I'm just messing with you. I hate it so much when YouTubers do this, like, make you wait all the way till the very end. I'm not going to do that. I know that you're busy. So here are the top 3 stocks. Coming in number 1 is QQQM. Number 2 is SMH. And number 3 is SCHD. That's it. Now, good luck and thanks for watching. Take care. Bye. Oh, you're still here. Awesome. Now that everybody with TikTok brain and the tiny little attention span has left, let's really get into this. In the video, I am actually going to break down these stocks and give you some in-depth financial analysis so that you can actually make some financial justification for why you might want to actually buy these stocks. So for those of you who don't know me, hi, my name is Rohit. I have worked in financial advisory as well as worked in fintech, and I currently have a bachelor's degree in economics and a master's degree in finance. So hopefully that gives you a little bit more trust in me and you don't feel like I am a blithering idiot talking about stocks. Also, I'm not some sort of internet guru who's going to tell you that if you buy these 3 stocks, you're going to become a millionaire overnight and going to make $10,000 a week or any rubbish like that. I'm not some roaring kitty preaching GameStop.
I like the stock.
Or anything like that at all. So the 3 stocks that I'm going to be talking about in this video are stocks that I've personally invested in. I quite like them. And I think they're a great starting point for anybody who's trying to build out their portfolio and reach some level of financial freedom. These stocks are not going to make you rich overnight, but they are a great base for your portfolio. So I've been using the word stocks quite a bit in this video, but to be super clear, I'm not actually going to be talking about 3 stocks. I'm going to be talking about 3 ETFs. So what is an ETF? Well, ETF stands for Exchange Traded Fund. And the best way to understand it is to say it backwards, meaning that it is a fund traded on an exchange. And for simplicity's sake, what is a fund? A fund is essentially a basket of stocks. So to reiterate, essentially an ETF is a fund that you can buy on a stock exchange the same way that you could buy stocks in Apple, Google, Facebook, whatever. So by buying an ETF, it's essentially like buying a small fraction of a bunch of different stocks at one time. And overall, it makes investing way easier and reduces your risk significantly. So the 3 ETFs that we're going to be covering today are QQQM, SMH, and SCHD. Let's start with QQQM. So QQQM is an ETF which is made by Invesco, and it tracks the top 100 companies listed on the Nasdaq stock exchange. So these companies include the likes of like Apple, Amazon, Tesla, and a host of other ones listed on the Nasdaq. And at the time of recording this video, QQQM is trading for $204.35 US per share. And so here are some of the reasons why I really like QQQM for 2025. Firstly, QQQM has a huge exposure to tech companies. So that's the likes of Apple, Tesla, Google, and so many more. What's really good about that is that buying these stocks individually is going to cost a ton of money. When you buy QQQM, you get a small sliver of all those big tech giants. The second thing I like about QQQM is that it has diversified growth. So essentially, because the QQQM is tracking the top 100 Nasdaq companies, that can include companies outside of just tech, right? You can get companies in healthcare and consumer retail. Because of that, you actually reduce your overall risk because you're not putting all your eggs into one basket, which is tech. You're actually spreading it across multiple different industries. The last thing that I really like about QQQM is that it has a very low expense ratio. So an expense ratio, for those of you who don't know, is essentially the fee that Invesco charges to run this fund. It's a small percentage which is actually taken out of the overall assets that the fund has, and it's not something that you directly are paying out of your pocket for. It just actually reduces the share price ever so slightly. And so the lower the expense ratio, the better the ETF, because that means that the fee is not going to hurt the share price as much. Some other cool facts about QQQM is its trading results. If you look at the historical averages over the last 2 years, it's actually increased by 29%. So what that means is that if you had invested $100 2 years ago, today you would have $129. And obviously that compounds, right? So every year you're going to be making more and more money. And the more shares you buy from this, the greater the actual dollar value of the return is for you. And based on a bunch of different analyst predictions, we can expect QQQM to grow between 8 to 12% in 2025. So again, if you put $100 in today, you would make $8 to $12 in return for your investment. And to finish our talk on QQQM, here are the top 3 companies within QQQM's basket of stocks. So coming in number 1 is Apple. So there's a huge exposure to Apple. Number 2 is Amazon, huge exposure to Amazon. And number 3 is Microsoft. So by buying QQQM, you're getting a large exposure to these 3 companies without having to actually invest in them yourself. All right, so that's everything on QQQM. So now let's move on to the next ETF, which is SMH. So SMH is an ETF run by VanEck, and it tracks the whole semiconductor industry. So that's big giants like NVIDIA, AMD, and so many others who are specialized in making semiconductors. And at the time of recording this video, SMH is trading for $239.95 US per share. Now, here are some reasons why I really like SMH for 2025. First is the huge growth potential. You have to realize that semiconductors are a crucial element in the supply chain for most big tech companies. And in particular, it is crucial for companies that are producing products in AI, in 5G, and in VR and AR. So by investing in SMH, you're essentially getting exposure to one step before the supply chain. Because as AI and 5G and VR and all these different areas grow, they're going to need more and more supply. And so that's when all the companies that produce the core components, like a NVIDIA and like an AMD, are going to skyrocket. The next thing I really like about SMH is that it has great exposure to the giants and the industry leaders in the semiconductor space. So like I mentioned before, NVIDIA, AMD, Taiwan Semiconductor Manufacturing, and a ton of other ones. So these guys are leading the charge in the AI and VR and 5G revolution. And so by having SMH, you're getting exposure to all of these companies. The final reason why I really like SMH is the strong demand potential. Obviously, as AI and these sort of industries grow, the actual demand to buy those shares and to buy those stocks is going to go up dramatically as well. So having more demand on the buy side is going to help the share price rise up even more. Now, some even cooler facts about SMH is its historical trends. Over the last 2 years, SMH has grown by 47%, which is massive. If you compare that to QQQM, like I mentioned before, that was only 29%. So this is a hell of a lot more. And just to break that down, if you had put $100 in SMH 2 years ago, today you would be having $147. And I can't stress this enough that that compounds. So the more money you invest in different ETFs, the greater the return for you. If you had invested, say, $1,000, you would have made $470 in return. So I hope that starts to make sense to you now. Now, for 2025, SMH is predicted to hit between 10 to 15% growth. So again, you invest $100, that means $10 to $15 you are going to make in return. And to finish up our talk on SMH, these are the top 3 companies within that fund. So number 1 is obviously NVIDIA. Everybody knows NVIDIA. It is always in the news. It is always breaking all these records for growth. So NVIDIA is one that it has huge exposure to. The number 2 holding is Taiwan Semiconductor Manufacturing. That's also a massive, massive player in the game. And the third one is Advanced Micro Devices. So this is also a massive player in the semiconductor manufacturing industry. So that's everything on SMH. Now let's move on to number 3, which is SCHD. Okay, so the final ETF we're talking about is SCHD. SCHD is an ETF made by Charles Schwab, and it invests in the top US high dividend yielding companies and has a focus on income generation and financial stability. At the time of recording this video, SCHD has a share price of $28.63 per share. Now, here are some reasons why I really like SCHD. Firstly, is that it has a very high focus on dividend yielding companies. Now, what is dividends? So essentially, dividends are a payment made by a company back to the shareholders. So it's kind of a way of sharing the profit or sharing the net income with everybody who's invested in the company. So what that looks like in reality is that if you own SCHD, every quarter you'll receive a check from them or a payment into your investment account of the combined dividend of the entire fund. So if the fund is paying out $1 of dividend per share and you own one share, you'll make $1. That's how it works. So if you're someone who is really adamant on boosting cash flow, then this is the perfect ETF for you. Because if you buy enough of this ETF, you can be generating enough dividend income and potentially fuel your cash flow. So if you compare SCHD to other ETFs like QQQM and like SMH, its actual growth rate is not going to be quite as high as those ones. But the fact that it's paying out a regular dividend income and the dividend on average is much higher than those other ETFs, it's a really great ETF to have in your portfolio because it can help you boost your cash flow. Another thing that I absolutely love about SCHD is that it is relatively much lower cost. Just like QQQM, it has a very low expense ratio, so the fee that Charles Schwab is taking out of this ETF isn't really going to hurt you that much. And on top of that, it's actually very cheap to buy. At just $28, I mean, you can buy a ton of this without really thinking. So to put that in perspective, let's say you bought 10 shares of SCHD, that would probably run you around $280, which is almost the same price as buying one share of SMH. Now, if both shares go up by $1, you're only making $1 from SMH, but you would be making $10 from SCHD. So that's why buying shares that are actually cheaper is really good because you can buy them in larger volume and therefore when they rise in price, you get a higher return. The last reason why I really like SCHD is that it chooses very high quality stocks to put in its portfolio. So if you look at the actual holdings within SCHD, all of these companies have very stable income, they are relatively much lower risk, and that is evidenced by the fact that these companies pay dividends. You know, big companies that are stable have the extra profits and have the extra income that they can actually redistribute it back to investors. If a company is growing really fast but doesn't necessarily have the net income required, it can't pay that back. So that's why dividends acts as a great evidence for companies that have financial stability and are relatively lower risk. Now let's talk about the historical trends of the ROI on SCHD. In the last 2 years, it has actually grown by 17%. So just like I mentioned before, that means if you invested $100 2 years ago, you would now have $117. So obviously that is lower than SMH and QQQM, but keep in mind, you would also have made dividend every single quarter. So that would have been 8 dividend payments over the last 2 years. And that dividend would probably be higher than anything you would get from SMH and QQQM. So keep that in mind as well. And if we project into 2025, the predictions are that SCHD should hit between 6 to 9% in growth. So again, you invest $100, that means you're going to make $6 to $9 in return on the actual value of your shares, and on top of that you'll probably make some income from the dividend payments every quarter. And the top 3 holdings within SCHD are PepsiCo, Home Depot, and Johnson & Johnson. And for me, this is also a massive win for investing in SCHD because you're getting exposure to low-risk companies that are not necessarily in tech or AI. These are just good, high-quality businesses. So essentially, if you ended up buying SMH, QQQM, and SCHD, you have enough diversification within your portfolio to help you reduce your risk. Like I mentioned at the beginning of this video, you don't want to be putting all your eggs in one basket. So by having various ETFs, which already have a sliver of multiple different companies, you're going to be able to reduce your risk significantly through diversification. And that is everything you need to know about SCHD. Okay, so now let's recap everything we've talked about in this video. The top 3 ETFs are QQQM, SMH, and SCHD. QQQM is the ETF that has exposure to the top 100 Nasdaq companies. So if you want to get in with companies like Apple and Tesla, that's the one to go for. SMH, on the other hand, has exposure to the top industry leaders in semiconductor manufacturing. So companies that are working on making the core components for AI, 5G, and AR and VR. And that's companies like NVIDIA and AMD. So if that's where you want to go, that's the one to go for. And then finally, SCHD is the ETF that has exposure to the top US high dividend yielding companies. So if you want to invest in companies like PepsiCo and Johnson & Johnson, that's the one to go for. Now, also keep in mind your risk tolerance or your risk profile plays a big role over here. If you are someone who wants to take a lot of risk and hope for the best returns, the one that I would personally recommend is SMH, because that one has the highest predicted return and it is fast growing, but it is also very risky. If you're on the other side of the risk profile and you want to invest in very financially stable companies that are low risk, that are going to boost your cash flow, so that's where an ETF like SCHD comes into play. If you don't want to really risk your money, you want a little bit of growth and you want some cash coming in, then SCHD is the best to go for. And if you're kind of in the middle and you want something which is risky, but also a little bit more on the stable side, so bang in the middle, that's QQQM, because it is investing in companies like Apple and Microsoft, which have been around for a long time and they are industry leaders and they're relatively lower risk than, say, NVIDIA. So that is my top 3 ETFs. If I were you, I would personally buy a little bit of all 3 of them. But again, that's just what I would do. This is not any hardcore financial advice. Please do your own research, have a look through, and build the portfolio that is right for you. Well, that's the video, everyone. I hope you enjoyed learning about my top 3 ETFs for 2025. If you want to learn more about finance and see how I personally track all my finances, my expenses and investments, etc., I have a video which I will link somewhere on the screen over here. Feel free to give that one a watch. Until then, I hope you have a fantastic day. Best of luck with building your portfolio and take care. Bye.